Welcome back to Monkeynomics. For any new students just joining us, this is an ongoing series to teach you what I know about finances and investments, and they're meant to be viewed in order. In our last lesson, we learned about asset diversification, and only touched briefly on stocks. But now we will be getting a lot deeper into stocks because they will make up the majority of your diversified portfolio, particularly if you're decades from retirement. So I'm going to focus on three issues: market cycles, emotional investing, and risk tolerance. The primary reason people lose money in stocks is because they don't understand it. Ignorance breeds emotional investing, and people blindly gamble and lose all their money, and then they blame the stock market instead of themselves. So let's start with market cycles. A lot of people understand that markets rise and fall, but that doesn't really help us much. What does help us is to understand how different industries benefit from each phase of the cycle. You can make money in any economy because people always need stuff, and those companies may become more valuable during a particular cycle. Or at the very least, they'll maintain their value and won't lose as much money as other industries. For example, the three industries that benefit during a quote-unquote bear economy, also known as a recession, are utilities, which include electrical and water providers, consumer staples, which are basic things like affordable food, clothes, etc., and healthcare, which is self-explanatory. This makes sense because even when the economy is bad, people need electricity, people need food, and people need medicine. So instead of pulling all your money out of stocks because you're worried about the economy, you can simply move your money into these industries. The secret, and listen up because this is extremely important, the secret is you have to rotate into these sectors before the economy turns. Too many people wait until the economy turns and then buy and sell, which is the worst time to do it. This leads us to our second topic, emotional investing. Using emotion in place of logic is what women do, but men do it too when they don't know what they're doing. Men quote-unquote go with their gut, which is just emotional thinking, and as men we need to be above this. I'm not saying your gut feelings should be completely ignored, and we'll get to risk tolerance in a moment, but the problem is that when you operate based solely on your emotions and what you feel, you're just gambling. Walk into a casino and ask someone playing craps why they're betting on one number and not another, and you'll likely be told that they can feel it or something like that. Don't do this with stocks. Wall Street is only a casino if you allow it to be so by remaining ignorant. Don't use emotional thinking for your investments. So here's how the emotional investor loses all of his money and why it's their fault. It begins with the bull market. People stay away from stocks until they believe that the stocks are quote-unquote safe, and then they overinvest in it. For example, during the housing bubble and the dot-com bubble, people who didn't know shit about real estate or tech stock were buying them up because they heard the hype and they felt that these were a sure thing. In reality, buying during the bubble is suicidal. The asset is overpriced, and by the time you've heard about it on TV about how great and hot it is, it's already made its money. The only thing that will inflate it further is when dumb people begin buying it for way more than a rational person would pay for it. Bubbles require stupid people to buy things they don't understand because of emotional thinking. They buy, and they think that the price is just going to keep going up forever because they don't know what they're doing. So everything's going great, but eventually the stupid people either come to their senses or they run out of money. And then the bubble pops. The crash occurs, and what do people do? They bought when the price was at its peak. So what do you think they did when the price hit its bottom? They sell, of course. They bought high, and they sold low, which is the polar opposite of what you're supposed to do. Here is the secret to stocks. Are you ready? Here it is. Buy low, sell high. Everyone knows this though, right? Everyone knows you're supposed to buy low and sell high. So why does everyone buy high and sell low? It's because they're following their emotions out of ignorance. You never invest in bubbles. If you think there's a bubble, you invest in what's going to go up once the bubble pops. Things like utilities, consumer staples, and healthcare. You think one shift ahead, and once the shift occurs, you sell your stocks once they skyrocket in anticipation for the next shift. Now, you can never time the markets exactly. And maybe you sell a little soon and miss out on some of the profits late in the cycle. But in the long run, you won't lose your shirt on crashes and bubbles because you're already one step ahead of the market. Let me demonstrate this using an analogy from Warren Buffett, who compared the process to the ball from Cinderella. Quote, The line separating investment and speculation, which is never bright and clear, becomes blurred still further when most market participants have recently enjoyed triumphs. Nothing sedates rationality like large doses of effortless money. After a heady experience of that kind, normally sensible people drift into behavior akin to that of Cinderella at the ball. They know that overstaying the festivities, that is, continuing to speculate in companies that have gigantic valuations relative to the cash that they are likely to generate in the future, will eventually bring on pumpkins and mice. But they nevertheless hate to miss even a single minute of what is one hell of a party. Therefore, the giddy participants all plan to leave just seconds before midnight. There's a problem, though. They are dancing in a room in which the clocks have no hands." Unquote. So this is the fundamental problem. Nobody wants to sell when the stocks are enjoying enormous gains, and nobody wants to buy when the stocks are in low demand. But paradoxically, that's exactly how you make money. Here's another analogy that may help you wrap your head around this concept better. Let's say you have children who need new winter coats each winter because they grow out of them each year. You don't buy the winter coats in the winter when they're full price. You wait until they go on sale in the spring, and you get them a size bigger, because you know that in a year your kids are going to outgrow their current winter coats, and they'll need new coats. And by buying them in the spring, you get them for 50% off or more, and you're prepared for the next winter. Market cycles are like the seasons, and just like you know we have 4 seasons, and you know one follows the other, we have 4 market cycles, and one follows the other. The differences between market cycles and the seasons is that there are no fixed dates on the calendar that say that on this date the recession will end, like we have with the seasons and the changing thereof. However, just as you can identify the seasons by the general weather, you can identify the market cycles by the general economy. If you simply understand market cycles, how to benefit from them, and how to avoid emotional investing decisions, you will be better than most investors out there. However, I mentioned previously that gut feeling shouldn't be totally ignored, and this brings us to risk tolerance. Risk tolerance is extremely important to determine because if you're not comfortable with the investment's risk, you're going to freak out when you hear something on the news, sell everything, and lose your money. Investing is about half about the numbers, and about half of how comfortable you are about the numbers. I would rather recommend something that earns an average 6% a year, but that I'll know you'll be comfortable with, than recommend something that earns an average 10% or more a year, that I'm worried you'll sell early and lose money on. So we need to determine your risk tolerance. I've seen a few different ways that firms use to determine risk tolerance, usually involving a questionnaire. But I've found that there are really only 1 or 2 questions that are important to determine your risk tolerance. The first question is this: are you retired? Or are you retiring in the next 5 to 10 years? If the answer is yes, you're going to want to stay on the conservative side of the scale, because if another recession happens in the near future, you may not have enough time to wait for it to rebound. The second and last question involves the following table. There are 5 sample portfolios, each with a maximum potential 1-year return, and a maximum potential 1-year loss. Take a look at these portfolios and simply ask yourself which one you're comfortable with. Now, it's very important not to simply go with something more risky than you're comfortable with, simply because you think it's the quote-unquote right thing to do. Your money should not be causing you stress, otherwise you're not going to live long enough to enjoy it. So take a look at the chart and honestly ask yourself which portfolio appeals to you based on the maximum 1-year returns, along with the maximum 1-year losses. Starting at the left, we have a portfolio that will not lose money, but it's only earning 3% a year, which, if you'll notice at the bottom, is the inflation rate. So you're really not earning anything, you're just maintaining your purchasing power. In essence, you're not losing money, but you're not gaining money either. The next portfolio could gain 10% but could lose 5%. The next portfolio could earn 20% but could lose 15%. The next portfolio could gain 25% but could lose 20%. And the last portfolio could gain 35% in a single year, but could also lose 30% during the same year. Now, none of these portfolios necessarily represent anything in particular. I just want you to think about which portfolio you would be the most comfortable with based solely on the information contained on the graph. Have you got it? If you need more time, just pause the video now until you've come to a conclusion, because otherwise we're going to move on without you. Alright, so based on what your choice was, here is what I would rate your risk tolerance at. Now remember our first question regarding whether you're retired or about to retire. If you are retired, but you chose something on the right side more along the aggressive portfolio, you're not being realistic. If you were living on your assets in retirement and you lost 30% in a single year, you would have a heart attack. So reevaluate both sides of the portfolio, not just the potential returns. Once you've identified your risk tolerance, there are several models that will help you identify what percentage of your portfolio should be made up of which asset classes we previously talked about. This is just a starting place to build from and shouldn't be taken literally. Also, whether you buy individual company stock, use ETFs, or use mutual funds, and which company you go with will all make a huge difference. However, these models are useful as a starting place to build from, and we'll get more into that next week. So that's it for this lesson. Please like, favorite, comment, and subscribe. Share this video with anyone you think it might help. Thank you for watching, and I'll see you next time.